That, let's move on and now put the spotlight on the FMCG space. The FMCG index, of course, has been a little lackluster. It's been underperforming in the last couple of weeks and actually throughout the last 1 year with about 18% returns. Now you contrast that with a 30% return on the Nifty, and therefore we're talking about underperformance. So are things likely to get any better? We've got Amnish Aggarwal, Head of Research at Prabhudas Lilladher, now joining in. Amnish, good to have you on. You know, in a market that's really hungry for growth, for pure play FMCG, you know, anemic 3-4%, you know, this mid-single digits, this is perhaps just not cutting it for the market, given the valuations that the stocks are still quoting at. Let's start with your broad thoughts as we get into this monsoon season, this election season. Are you expecting a pickup in top-line growth, starting with the top line, then we'll come to margins?
You see, top-line growth might have bottomed out, but it is not likely to accelerate at a very fast clip because of two reasons. One being that the demand is improving, but there is a significant increase in competition from the regional players or the smaller players who have come up very strongly in select categories. And secondly, given the fact that the raw material prices had corrected, some of the companies had taken the price correction, and also there is no reason now for the, you can say, increase in the prices in the near term. So the growth will continue to be volume led, and till the time there is more clarity on the monsoons or there is significant pickup in the rural demand, I don't see any meaningful acceleration in the top line growth.
Amnish, particularly on Avenue Supermart, after a long period of underperformance, it appears the street is getting bullish now. They believe the valuations are reasonable, maybe even attractive. You know, ICICI Securities was the latest one to upgrade it. Before that, we had CLSA, and target prices are now above 5,000 rupees also for Avenue Supermart. Do you think its time has come?
You see, in fact, as an anti-consensus, we have been positive on this name, even say 6 months, 12 months back. The company has undergone a lot of pressure in its performance, be it, you can say, some loss of business, which they got more so on the apparel side in the general merchandise and apparel, or be it, I would say, the volatile growth, which was due to, you can say, COVID or the post-COVID era. Now, if you look at, say, past couple of quarters, the things have stabilized. The pure EBITDA growth has started moving up, and now I think the company should be back to a phase of at least 20% plus kind of a growth incrementally from here on. So I think given the kind of consolidation which the stock has undertaken in the last 1.5 years, this is one name we have been very positive about in the long term, and it remains one of the structural stories with scope to give much superior growth in comparison to most of the consumer names. And in the last couple of years, the P multiples have now corrected and are much more reasonable than what they used to be.
All right, Amnish, good morning and congratulations on that call. I recall when we had discussed that stock as well earlier, you look quite bullish on Avenue Supermarts, a few months ago. But I wanted to ask you about Godrej Consumer. Yesterday, the FMCG index itself and all the stocks were a little under the weather. But Godrej Consumer Products was higher in trade yesterday. I think it went home with gains of around 2.5%. And technically, it did cross the 20 and 50 DMA. That's about the technicals. But fundamentally, how is the stock, positioned right now? And what are the triggers you're looking at going ahead?
You see, Godrej is a name we are not covering as such. Okay. So I won't be able to give you any, you can say, concrete numbers per se. But I think it is a function of where some of the segments of the company are doing, and because a lot of business of the company is also coming from outside. So practically, it's slightly difficult for me to give you any concrete reasons.
Okay. So, Amnish, to go back to the main call that you've made, this is not going to be about a significant pickup in top-line growth. I don't know, in terms of margin expansion, whether there can be any real outperformers. Just run us through your top calls. We've spoken about Avenue. Beyond Avenue, what else do you think could be a dark horse? Because FMCG has been an ignored and unloved sector for pretty much all of FY24.
The problem today is that, like I said, the volume growths are not picking up on a broader basis. The margin expansion is unlikely to happen because there is a lot of competition from the regional and smaller players, which are you can say, which have got lower pricing. And if you look at particularly last 5-7 years, most of the companies have seen significant increase in their margins. So on an average, the margins might have gone up by even up to 5, 7, 8% for many of these companies. And now lot of companies in this sector believe that there is very little scope to increase margins incrementally, which means that your bottom line growth should be more or less, you can say it is plus minus 2-3 percentage points of your top line growth. And in an environment where top line growth is unlikely to be high, bottom line growth is also unlikely to be very inspiring for most names. Now, in such a scenario, and given the fact that we have seen the big rally in the P multiples over the years, and now many of these cyclicals, infra, and many of these other sectors are coming up, there's a chance and there's a high probability that the P multiples for consumer names in general and FMCG in particular will become range bound, or they might go even further correction from here on. So in this sort of a scenario, we are not very bullish on many staple names in particular. Maybe ITC can give you, say, a trade of around, say, 10-15% from here on. At lower levels, Lever might give you, you can say, maybe 10% return over the years. But definitely, given the fact that your bottom line growth prospects are not very great, so we are not currently, you can say, recommending many of these staple names. On the discretionary side, yeah, like Avenue, Titan, some of these names we have been positive about, but we will evaluate them as we go along, depending upon how the demand scenario pans out.
What about paints, Amnish? What have you made of the pricing of Birla Opus? Their products are largely priced at a 5% discount to Asian Paints. Would you call it aggressive? And what's the investor feedback on the paint industry now? Because Birla Opus has a target that they want to hit revenues of 10,000 crore in the next 3 years with EBITDA profitability. With these kind of aggressive targets, is there a risk that the entire sector could be pressured for 3 years?
You see, the sector is actually at the crossroads. Paints as a sector has seen over the years practically every big MNC coming, lot of competition was always there in the sector. But the kind of investments which Birla Opus has committed to the tune of, say, 10,000 crores, multi-locational plants, and entry into, you can say, products across the segment ranging from an economy to the premium products, wood finish. So this kind of an entry, no new player has done ever. Given the kind of investment they have committed, the distribution they are setting up, and the pricing which they have started with, I think 5% is in general pricing which is lower. And I think what they had announced was that in water-based paints, which are considered to be, you can say, slightly premium and which sell more these days, the difference is they are giving incremental 10% volumes also. So I think in the near to medium term, I don't rule out a possibility of some sort of a shake-up happening in the industry. Obviously, it is going to impact the players with a very low market share, some regional players, local players, more than some of these organized players. But in this kind of a scenario, till the time the dust settles, we would tend to avoid the entire, you can say, paint stack for further investments.
Okay, so I guess stuff going, high valuations, anemic growth, not much margin expansion. So let me stick to the two stocks you mentioned. We've discussed Avenue already, and you mentioned Titan. I was noticing actually, there's another positive view on the stock today. Motilal, by the way, has a buy rating, I think, and they're expecting about 14% upside on the stock. But the question really is on valuation, Amnish. Yes, it has the tailwinds, perhaps a great franchise, and we're talking about the strong discretionary demand. But how do we sort of grapple with the valuation issue for something like Titan, which is now what, closer to 55, 60 times forward earnings?
Yeah, absolutely. That's why I said that we will take a call on valuations and all as we go along, because the stock has given 20% returns in the last, say, 6 odd months. It used to be 3,000, 3,100 levels. That is one. Secondly, a lot depends upon how the sales momentum goes in the coming 6 months or so, because first of all, gold prices are at an high. Secondly, the upcoming marriage season might be weak because the number of marriage days are low, both in you can say the Hindi heartland as well as in South India. So in the near term, it might be range bound. In the long term, it remains a good story, but definitely the expansion in P multiples is unlikely to be anything meaningful or significant from here. But what happens usually is that when there are lesser alternatives in the broader consumption space, the stocks may continue to do well or outperform.
In the nature of this market, it's a unique beast, the Indian stock market, right? Thank you so much, Amnish. Good chatting with you this morning. Thanks for all the perspective. Since we were discussing